Hello, everyone. So welcome to today's class. So this is class 1 of the 8 for the CAA Accelerator Bootcamp. So I'm going to just give you a high-level overview of the structure of a class, and then we will jump straight into it. So the program is 8 lessons of 90 minutes each. Of the 8 lessons, 4 lessons will be spent on FAR and another 4 lessons on math. So the first 2 weeks will be on FAR, and then the last 2 weeks will be on math. So I've received 2 question papers. Now, the question papers is 100 marks each of 3 hours. So that means if I receive 2, it's 200 marks. Now, 200 marks means 6 hours, but that is if you're writing under time pressure. So we're not doing this under time pressure. So what I will be doing, I'll be taking some from this question paper 2 and some from paper 1. So we'll do some groups and then some non-group related questions. So what I'm going to do today is I'm going to do question, I think it's question 2, whatever, we'll see which paper it is now. Yeah, it's paper 2. And of 20, so it's your final exam of 2020, paper 2 I'll be covering. I've added it to the folder. You should have received an email from Eddie Hans with access to the Google folder. So I'm going to drop everything over there. Also the workbook, like when I work through a question, I use Google Sheets or Excel, and it'll be right there for you. And I'll also load I'll put the recorded videos also over there. So just one place for you to access everything. So basically what I will be doing is, what I'm trying to say now. So in today's class, so the scenario, one of the important aspects before you can even answer a question is to understand the scenario. So the scenario is quite long, it's 8 pages. And so I'm going to spend today's session in reading through the scenario. As I read through the scenario, I'll mention important aspects. So the whole idea here, although I'm going to spend quite some time reading a scenario, you obviously in an exam can't read so long. But the point of it is for you to pay attention as to how I read. So when you practice, you also try to develop that level of reading until you can get to a point where you can read it within 30 minutes. Because remember, I think you get 30 minutes to read your scenario. It's very important how you read the scenario. So are you just reading for the sake of reading, or are you actually reading to understand? So I will teach you how to read to understand. So as I go through the scenario, I'll show you how I'm reading. So you must pick up how I'm reading, and I'll also bring it to your attention. What are the key aspects to pick up as we go through? So although we won't tackle actual question, actual required, part of the learning is the way of thinking. So part of the approach that I follow is to help you to develop a way of thinking. Because remember, no matter which questions we cover, it's no guarantee that that's going to be what's going to come in the final exam. The same principles they will test, but how it gets tested is very, very different. And that is why, in order for me to help you to pass an exam, I must be able to help you to handle any question that come your way. So how do we do that? It's basically, number 1, to make sure you understand the scenario. Number 2, you understand the required. And then number 3 is to help you to identify what other which topic is being tested, and then for you to be able to once you identify the topic, that you are able to identify the key issues within a topic. So for example, the question we're going to cover, not today, in the next lesson, is the revenue question, right? So what do we pick up? So when we read through the scenario, you'll see how I read through the scenario and how to pick up important aspects. Then when we look at the required, we try to understand the required. You're going to see the required is about the revenue, but you need to know exactly what about revenue you need to discuss. So now when we identify its revenue, what you want to be able to do is when you see you have to deal with revenue, you want what must come into your mind are the key issues when it comes to revenue. What are the key issues of accounting when it comes to revenue? So that is basically what I want to help you with. It is more an approach to answer any question and give you the fundamentals of understanding the key issues. I know I've been in discussion with Justin, and you guys are not so much interested in theory. So we're not going to focus so much about theory because I think he said that you guys are fairly comfortable from a theory perspective. It is more taking the theory and applying it to questions. So most of the work is going to be about that, taking a question paper and applying the theory. But remember, to apply the theory, you also need to understand the scenario. So that's basically what we're going to focus on today. Okay, is there any questions? Um, uh, any questions before we jump into the scenario? No questions? No? Okay. So I'm going to just switch over into the scenario. Okay, so you should be able to see, this is one of your questions that I received. I dropped it in the Google folder as I made mention. As you can see, you should be able to see, just tell me if you can't. As you can see, it is a financial reporting 2020 exam, and this is just the scenario. It's 100 marks. You can see over there, it is 8 pages. So I'll show you, you're obviously going to get this in an exam, so many pages. So I'm going to read the scenario, and I'm telling you how to navigate the scenario. I'm also going to show you how to, when you look at the required, how to know where in the scenario you need to look. Okay, so you can see it's a lot of information. So we're going to go through it nicely, because remember, if you can't figure out what the information is all about, no matter whether you know your theory, you're not going to be able to answer the exam question. So let's just jump into it. So they're telling you over here, all amounts exclude VAT unless otherwise stated. So all amounts exclude VAT unless otherwise stated. So they say Gibela, a Zimbabwe stock exchange listed entity, has 2 business units: software solutions. Can anyone else have a hearing? Can someone just indicate if you can hear? Okay. So maybe it's your connection or something, so you can just check your side. Okay. So let's say Gibela, a Zimbabwe stock exchange listed entity, has 2 business units: software solutions and property rental. Okay, so you want to be able to picture that in your head. So what you want to picture is the company, Gibela, and below it, it has 2 units. One is software solutions, and the other one is property rental. Each unit generates income independently of each other. Okay, so this is very, very important when it comes to financial reporting. Each unit generates income independently of the other. Okay, so why that's important in financial reporting, you deal with the accounting standard impairment of assets. Now, under impairment, when you impair, you're always looking for the smallest group of assets that can generate in cash inflows independently. So here you can see software solutions is a cash generating unit, and property rental is a separate cash generating unit. So just take note of that. PRU generates its income from letting out property, and SSU generates income from providing software solutions. SSU commenced operations on 1 January 2008 and all assets attributable to this unit were bought after this date. Gibela has a 31 December year end. The 2019 financial statements are in the process of being finalized. However, there are some matters outstanding which have been brought to your attention. You are a second-year trainee accountant in the finance department of Gibela. Okay, so the important aspects really over here, you have a company with 2 units. Okay, so in this whole paragraph, what is really standing out, you have a company with 2 units. The units generate cash inflows independently. So what does that mean? Each unit is a cash generating unit. So that's important for impairment purposes. Then you're busy with the 2019 financial year end, and your financial year is 31 December. Okay, so that's really the important aspects out of there. So note number 1. So generally, because I have different notes over here, the required will probably lead you to a particular note. So that is how you'll guide yourself in an exam. Okay, but for now, we're going to go through the entire scenario to identify the key issues within the scenario, just to get a nice understanding, so that when we go through the required or some of the required, we will have an idea of what the company and what the scenario is all about. So the Gibela Software Solutions unit is a leading software and service-led enterprise. SSU offers a range of solutions that help businesses of all sizes compete in an ever-evolving landscape of physical and digital consumers by providing software, advisory and consulting services, hardware support, and managed services that run end-to-end. SSU's portfolio includes multi-vendor connected device services, automated teller machines, point-of-sale terminals, and self-service technologies. Okay, so here you can see there's a lot of stuff happening over there. Important, at least for now, is that they are a service provider. Okay, I mean a software service provider. Okay, so that is just basically a lot of information going on over here. We'll probably have to come back to looking to find a detail if there's something specific relating to that. But for now, it is just basically, like the way I see it, as background information. Okay. In 2010, Gibela's innovation team noted that customers were more time-starved and demanding than ever, and supermarkets were failing to timelessly serve customers. To this end, Gibela carried out research on what solution they could offer to supermarkets so they minimize time spent in queues by customers. After extensive research and assessment of viability, Gibela decided to offer self-checkout solutions to supermarkets so as to ensure shopping is fast, easy, and convenient for the new generation customer. Okay, so there's something like what Amazon is kind of doing. I think a few retailers are coming up with something like this as well. I think Checkers here in South Africa is also planning something similar. The self-checkout was designed to be easy for customers of all ages to use. It allows customers to pick the products they want, scan the price tag, bag, pay, and be on their way out. On 1 January 2012, Gibela launched the new solution, the Fast Lane Self-Serve Checkout, FLS. FLS allows the supermarket's customers to scan, bag, and pay for items on their own using a self-checkout machine, while one of Gibela's system associates, an employee of Gibela, monitors from a nearby station to ensure positive shoppers experience. And once again, kind of a background, almost sounds like a management accounting type question with all the backgrounds. Okay, So here they're saying in 2019, so there you can see this whole page over here. To a large extent, it is kind of background giving you some idea. No real information that pops, that stands out from a financial reporting point of view. That's important for you as a CTA student. Remember, as a CTA student, you must be able to identify what information is relevant, what information is not relevant. Okay, so just take note of that. What information is relevant and what information is not relevant. I'm not saying this is completely irrelevant, but as you're reading the scenario, we don't know what the required is. As we're reading the scenario, there's nothing specifically that's jumping out in your face that's saying, here is a financial reporting issue, okay? Here's an accounting issue. We may use this to substantiate certain stuff, but at this point, nothing really standing out. Okay, so here they're just giving you a picture of the self-scanning. Okay, so here they say in 2019, the standard contract terms set by the sales team for the FLS are as follows. So here you can see is a contract for the set by the sales team. So it's most likely gonna so this is most likely gonna be something got to do with revenue. Okay, so we know here will probably be important information that will help us to figure out revenue recognition in terms of IFRS 15. So in 2019, the standard contract terms set by the sales team for the FLS are as follows. Gibela will provide the supermarket with a self-service checkout machine, which it manufactures. Gibela's estimated selling price of each self-service checkout machine is 11,000. What is Zimbabwe? Is that dollars or something? Okay, inclusive of VAT. Okay, so here's now some important. Aspect. When we're dealing with financial reporting, we want an exclusive VAT amount. Why? Financial reporting is only interested in what we want, and so from a revenue point of view, we want the exclusive VAT amount. The VAT portion will go as a payable to the revenue services. Okay, because it's not us. The VAT portion is not ours. The VAT portion belongs to someone else. Okay, so important to take note. So they're giving us an inclusive VAT amount. When we want revenue, we need to calculate the revenue from an exclusive VAT amount point of view. Okay, so just take note of that. Here you can see they're talking about a self-service checkout machine. So remember, when it comes to revenue has five steps. You know, the first step is that there's a contract with the customer. Okay, so step number one, there must be a contract with the customer. Okay, so here you can see here is a contract. If it's with a customer, then it will call it meet step number one. Okay. Just also take note, a contract doesn't need to be a physical contract. In this case, it is a physical contract, but it does not have to be a physical contract. Okay. The second step is to identify the what is it now? To identify what am I looking for? To identify the separate components. Okay, so that's very important to understand, to identify the separate performance obligations. Okay, so step number two is about identifying the separate performance obligations. So when it comes to performance obligations, so like the basic example, or a simple example that we will maybe understand is a cell phone contract. So let's say you take out a cell phone contract. The cell phone contract can be, let's say, I'm talking in rands. Okay, so just because that just comes easily out of my mouth. So let's say a cell phone contract is 200 Rand per month. The cell phone contract provides for a cell phone. It provides for data. It provides for SMSs. It provides for minutes, okay? Talking minutes. So it's one price, 200 Rand per month, yet there are different aspects. The question we need to ask ourselves is each of those four things a separate performance obligation, or is it one performance obligation? Okay, so that's basically step number 2. Step number 3 is to identify, or not identify, is to determine the transaction price. So step number 3 is to determine the transaction price. Step number 4 is dependent on step number 2 and step number 3. What is step number 4? Step number 4 is to allocate the transaction price that you determined in step number 3 to the performance obligations you identified in step number 2. And then lastly comes step number 5. Step number 5 is now recognizing each performance obligation based on how you earn revenue. Remember, there's only 2 ways you can earn revenue, either over a period of time or at a point in time. Okay, so that's basically the key issues. So those are the 5 steps and the 5 key issues of each of those steps. Okay, so in this one, they're telling you we provide a supermarket with a self-service checkout machine, which it manufactures. So generally, when you provide someone with an item, right, the checkout machine, you're just selling to them, and once you hand it over to them, generally the obligation that you owe them is actually provided. So remember, this will most likely be how you recognize revenue with this one is at a point in time as opposed to over a point in time. Okay, so that is kind of what it looks like. Okay, so just take note. As you read, you want to pick up the important aspects. Okay, so here they're telling you, we provide the supermarket with a self-service checkout machine, which it manufactures. And then they're giving you the price. So what do? We're just providing them with a machine. There's nothing else we're doing. We're just saying, here's the machine, buy it or do not buy it. Okay, so that is basically it. Number 2, the machine will be loaded with software that integrates with existing point of sales applications. The self-service machine is redundant without this software. Now, here's very important. Okay, the self-service machine is redundant without this software. Gibela's estimated selling price of the software is 35,200 inclusive of VAT. Once again, they're giving us an inclusive of VAT amount. So just at point number 1 and point number 2, there's some important aspects. Point number 1 says the contract provides for a self-service machine. Point number 2 says the contract also provides for a software. What was it? Also provides software, right? So it could be that the self-service machine and the software are 2 separate performance obligations. It could be that the software, the self-service machine and the software is 2 separate performance obligations. However, it could also be that the self-service machine and the software is 1 performance obligation. The question is, which one is it? Now, this sentence over here kind of gives us a clue that they're telling us the self-service machine is redundant without the software, meaning if they don't take the software, if the machine does not have the software, the machine is useless. So in order for the machine to actually work, it must have the software. So therefore, because the software is an integral part of the machine, it may appear that it is not 2 separate performance obligations, but it is one performance obligation. Okay, just take note of that. For example, your cell phone. You don't need data from your service provider for your cell phone to operate. If you connect to Wi-Fi elsewhere, your cell phone will operate. So therefore, the data is not like an integral part of the phone. Okay, so just that is basically what I need to think about it. Okay. Okay, once again, inclusive of that. So when we work out, so that's important. They say that the software is developed by a third party known as Software Guru. Gibela is the only company in Zimbabwe licensed to sell and distribute the software. Its competitors are foreign companies who sell the software separately. Okay, so this is now like this makes it even more complex. So what do we know is that in point number 1, they're telling us the contract provides for a self-service checkout. Okay, I mean, a self-service checkout machine. Okay, so that is basically what we're selling. But in order for the self-service checkout machine to actually work, it needs the particular software that FLS also provides. Okay. Now they're telling you that the machine can't operate without the software. So at that point, it may appear that it is one performance obligation because without the software, the machine can't operate. Okay. But now this bold aspect is very important. They're telling us that in Zimbabwe, Gibela is the only one that have the license to sell and distribute the software. But then they're saying there are foreign competitors who sell the software separately. What does that mean? It means we can actually buy the self-service machine from Gibela and get the software from someone else. Maybe not someone in Zimbabwe, but a foreign company. Okay, so that is so that now throws a spanner in the works. We have to look into a little bit more detail to see now whether the software is really integral. So yes, this sentence tells us it's really integral, but it does not. But this over here tells us, although the software is integral, we don't need to buy it from Gibela. We can also get it from a foreign company because they sell the software separately. Okay, so that could indicate now that although the self-service machine is useless without the software, because the software can be bought separately somewhere else, it can indicate that the machine and the software is two separate performance obligations. If it wasn't for this last sentence that is highlighted, then it is 100% certain that the machine and the software is not two separate performance obligations, but one performance obligation. But because of the last sentence that's highlighted in blue, it may indicate that the two is separate because we can get the software somewhere else. Okay, so this is why the contract, when IFRS 15 came out, why companies scrambled to fix up their contracts, because there was these kind of things that needed to be clear in a contract to make sure that when you recognize revenue, you're recognizing revenue in the correct, applying IFRS 15 correctly. Okay. So Gibela would also provide technical support for 365 days a year, 24/7 for free for 36 months. Gibela usually sells technical support separately at 500 per month to customers that have already imported self-checkout machines. Okay, so this is clearly a separate performance obligation because of the fact that it's generally sold separately. So it's generally sold separately. So because it's generally sold separately, it is a separate performance obligation. So although they're providing it for free, we still have to allocate a portion to revenue for the support. Okay. An associate person who is an employee of Gibela will be at a nearby station to the self-checkout. The associate has a technical expertise on how the system functions and assist shoppers struggling with self-checkout system. The associate will be provided to the supermarket for the first 3 months. The supermarket is set up for the self-checkout. This will be done for free. After 3 months, the associate will no longer be available to assist shoppers. At this point, it's upon the customer to decide whether they want to use their own employee as an assistant. Gibela does not offer this service to customers that did not buy self-service machines from them. The cost to Gibela for posting the employee is 2,500 per month, which equates to the employee's monthly salary. Okay, so you see the number 4 is slightly different. Number 4 is slightly different to number 3. In both cases, they're providing a service for free. In number 3, they're providing technical support for free for 36 months. In number 4, they're providing an assistant for free for 3 months. But the big difference in number 3 is that they sell this product separate. They sell the service separately. So because they sell the service separately, we will most likely record this as a separate performance obligation. This one here, however, is not provided separately. You can't provide it separately. So in that case, we'll have to look in a little bit more detail. But in that case, generally, when it's not sold separately, then it will be part of, it won't be a separate performance obligation. Okay, so it'll be part of the original contract. So just take note of that. Point number 5, supermarkets will have a free 1-year warranty that covers full replacement of any self-checkout machine due to any manufacturing defects. Now, IFRS 15 have specific guidance on how to deal with warranties. Okay, so when we deal with this when we answer this question, we will look at IFRS 15, and I'll show you which paragraphs in IFRS 15 deal specifically with how to treat a warranty. Okay, so they say due to the steep capital investment associated with constructing a single self-checkout machine, supermarkets are expected to pay 50% of the contract price relating to the self-checkout machine upon delivery. The rest of the balance and other items provided in the contract will be paid for evenly over a period of 36 months in arrears. Okay. So remember, 36 months, we'll have to find out whether that is normal credit terms. It's generally not normal credit terms. Then that means we'll have to do a present value calculation, because revenue must be the fair value today. Okay, so that's important. As part of its drive to increase sales, Gibela promised that all sales made have a 3-month return window where customers will be fully reimbursed should they decide against the concept of self-checkout. Historically, 3% of total sales are returned. Okay, so here's another issue. So here you have a warranty, but this here is something known as right to return. Okay, so there is specific guidance on how to deal with right to return. So this here is a very good revenue question. It is testing revenue quite thoroughly, because what's happening over here, we need to identify whether items have a separate performance obligation or whether they are one performance obligation. That's one of the critical things. Number 2, we're going to have to determine a transaction price. Okay. Now with the transaction price, we also have to, there's some stuff that is provided for free. So when something is provided for free, it is known as a variable consideration. We'll have to consider how to factor that discount into the with the transaction price. So when something is free, there's a discount. Ultimately, it's a discount being provided. We need to see the specific guidance on how to deal with a discount. So we'll have to work through those specific issues regarding how to deal with a discount. Then we also have a warranty, the specific guidance regarding how to deal with warranties. And then there's also this issue of right to return. Okay. And then there's also this issue over here, potential issue of needing to make use of time value of money. We will only make use of time value of money if 36 months is considered beyond normal credit terms. 36 months most likely is beyond normal credit terms. So then that means we'll have to apply time value of money discounting. Okay, so there's lots of issues happening all within these 7 points of note number 1. Okay, Gibela sells the self-checkout machine separately from other promises in the standard contract. Okay, so that is important to take note. When they sell something separately, then generally it means it is a separate performance obligation. Okay, the local customers always buy the entire package, as Gibela is the only software solution provided in Zimbabwe with the know-how of configuring the self-checkout machine software. Okay, so basically here it's important to take note now. So Gibela's, based on that information, based on all the information up until here, okay, Gibela's customer base is basically twofold. 1, foreign customers, 2, local customers. And you will treat each group of customers. So you won't treat all customers the same. You will treat each group of customers based on their circumstances. So if Gibela sells to a foreigner, then most likely almost everything within that contract is a separate performance obligation. Not everything, almost everything. But if Gibela sells to a Zimbabwean customer, then most likely the entire thing is one performance obligation or something like that. So it won't be 100% the same between recognizing revenue for a foreign customer versus recognizing revenue for a local customer. And it all got to do with this paragraph over here. So when I answer the question in our next lesson on the revenue, then I will reiterate these points so that it's crystal clear in your minds. Okay, so let's finish up this. So they say Gibela entered into a contract with Pick and Drop Supermarket on 1 January 2019 for it to fit all of its Harare stores with self-checkout machines. So here you can clearly pick up it is a Zimbabwean customer. Pick and Drop purchased 3,000 FLS packages. So they bought 3,000 packages. Okay, so now we know each package. So now we can work out the cost of each package and multiply it by 3,000. That will give us the transaction price. But we still did not do step number 2. Step number 2 means we have to identify the separate performance obligations. Okay, so from point number 1 to point number 7, we'll have to identify the separate performance obligations. So basically, what we would do is when we discuss it, we start with this one over here, the machine. We discuss whether it's a separate performance obligation or not. The software, separate performance obligation or not. Technical support, separate performance obligation or not, and things like that. Okay, so we will deal with that. And it's easy to work out the total transaction price is generally easy. The difficult part is going to be more the adjustment to the transaction price, which is for the discounts and the right of returns. Okay, so that is going to be, that's all. And then the next challenging part is to take the transaction price and to allocate it to the performance obligations that you identified in step number 2. Okay, so due to the size of the order, Pick and Drop negotiated for a discount as detailed below. So now here's another discount. Okay, so 10% of contract price, as Pick and Drop would make payments 1 year in advance for the 36 months. For the 36 months, the contract amount is due. Gibela and Pick and Drop have agreed on a contract price package of, okay, so here you can see they're giving us a price 45,800 times 3,000. Okay, so and it's not 45,800, it's 45,800. Take out the VAT times 3,000. Okay, so there's a 10% discount, and they say a 5% discount on self-service checkout machines, as Gibela will only enjoy economies of scale on bulk orders. Okay. Okay, so we will deal with this. So remember, this is now specific to Pick and Order. I mean, what is it? Pick and Drop. And the specific criteria for Pick and Drop, but on a general basis, we have to apply the normal contract agreement, and then just adjust it based on the specific items mentioned for the specific contract with Pick and Drop. Okay. So before we go on, do you have any question that's popping out of your mind? Any questions? Nothing? Okay.
Nothing from me.
Okay, so let's continue. Give me 1 minute. Just going to put either moving to a better Wi-Fi area. Give me 1 minute quickly. Okay, so another question. So let's carry on. So that is revenue. So that is a nice revenue question. It's going to detail the 5 steps nicely. And so when I deal with that question with you, I will explain further how, and then we'll deal with the specific accounting standard, IFRS 15. And so although we will have to answer it based on this question, I'll also show you how it could have been different if certain information had to be there. Okay, so that you look at it, you look at IFRS 15 not only based on this scenario, but what if they changed a few things? What would the outcome then be? Okay, so that is what I'll focus on the next our next lesson, answering IFRS 15 question. But let's continue reading the scenario. So before I move on, so basically you want to get to a point when you read, you're reading like this. Obviously, I'm taking much longer because it's part of the lesson, but when for your purposes, you want to get to, you must be able to read it in 30 minutes. So if you train yourself to read like this quickly all the time, then you will be able to pick up all these important information when you answer the question. Okay, so try when you read a scenario, don't just read it for reading's sake, because you want to try to read it with some understanding. So here we go, inventory purchase, note number 2. So they say on 27th, so remember our financial year is 1 January to 31 December 2019. So they say on 27 November 2017, Gibela entered into a 5-year supply agreement with the main supplier of microchips to secure the supply of microchips. Microchips are a critical component needed in the production of self-checkout machines. Due to excess demand of microchips, the main supplier has not been able to deliver orders timeously, as they always have backlogs. To secure uninterrupted supply, Gibela and the supplier entered into an arrangement where the supplier would erect a manufacturing plant on the supplier's land to supply Gibela with microchips for 5 years. The plant became ready and available for use on 1 January 2018. The terms of the supply agreement included the following. Okay, so the capacity of the plant is 100,000 units annually. Microchips manufactured in the plant are sold primarily to Gibela. Gibela is required to take up a minimum order of 80,000 units annually, although some of the microchips can sometimes be sold to other customers on an ad hoc basis on Gibela's approval. Gibela had agreed to pay the supplier $5 per unit produced. This is the supplier's variable production costs, variable production costs plus a 25% profit margin. Gibela's management expects to order 90,000 units annually. The price will be adjusted for changes in CPI at the end of each year. The payment is made annually in arrears. Furthermore, Gibela has to cover all the fixed costs estimated at 120,000 per month. All fixed costs must be paid annually in arrears. If the supplier produces and sells microchips to parties other than Gibela, the portion of the fixed costs relating to such work will be refunded to Gibela at the end of that particular year. That is, if the supplier produces and sells 15% of its production to other parties, the supplier will be liable to refund Gibela 15% of the fixed costs. Okay, so this is basically an arrangement where a company, so here you can see Gibela, which is our company, and their supplier is entering into agreement. The supplier is basically building a plant specifically for Gibela, because so there's this basically type of arrangement. So there's this particular accounting standard that deals with this. So I'll show you how to work through it when we cover that part of the question. Okay, so just take note. So what was important to take note over here is that there is a special arrangement where a PPE asset is being produced. So the supplier is building a manufacturing plant. A manufacturing plant is a PPE asset. This PPE asset is being built specifically for their customer. Who's their customer? Us, Gibela. So that is basically the important relationship to understand. So generally, this question is going to be asked from the supplier's point of view and not from Gibela's point of view. Okay, so just take note of that. This type of question, with this type of arrangement, is the question, the main accounting treatment is the accounting treatment from the party that has the PPE asset. Okay, so who has the PPE asset? It is the supplier. But we'll go into detail when we cover that particular question. So they say the interest rate implicit in the contract could not be determined. Gibela's incremental borrowing rate was 12% on 1 January 2018. CPI was 3% and 5.5% on 31 December 2018 and 31 December 2019, respectively. In FY 2018, 95,000 units were taken up by Gibela and the rest of the units were sold to the third parties. The accountant of Gibela believes that the transaction constituted a purchase of inventory and thus raised the following journal entries in the books of Gibela. Okay, so debit inventory, credit bank, debit inventory, credit bank. Okay, so so I guess it's not actually going to be asked from the supplier's point of view. It will be asked from our Gibela's point of view. Okay, but what we will do, even though they're asking it from Gibela's point of view, we'll also discuss what if they asked it from the supplier's point of view. Okay. But there's not a specific standard, but there's going to be a specific, one of the standards deal with this specific issue. So it deals with other stuff, including this particular issue. Okay, so now we deal with note number 3. Note number 3 is dealing with a property rental unit. Okay, so the property rental unit offers rentals of office space to the general public. The PRU has 2 classes of customers, local customers and foreign customers. 65% of the property being let out is within Zimbabwe and 35% is in South Africa. Gibela occupies 5% of each of the properties it lets out so as to render administrative services to its tenants. This is considered to be a significant portion that should be accounted for separately. Okay, so it's important to take note over here that when you have property, right, and the objective of the property is to earn a rental income and or to earn capital appreciation, then the property must be classified as investment property in terms of IAS 40. Now, so this is IAS 40. So here you can see a portion of the building is being used by Gibela. So when a company uses a building, then that building is considered to be owner occupied, and any owner occupied building is PPE. So here you have a situation where 95% is basically investment property and 5% is basically PPE. But the accounting standard says if a small portion is used by a company, then the entire property can be classified as investment property. So the question over here is, do we classify 100% as investment property and 0% as PPE, or do we classify 95% as investment property and 5% as PPE? As you can see, they're telling us that 5% is considered to be significant and should be accounted for separately. Therefore, 95% of the property must be classified as investment property and the other 5% will be classified as PPE. Okay, so you must be aware of that. If it was insignificant, then 100% could be classified as investment property, even though a portion of it is used for, even if a portion is owner occupied. Okay, so just take note of that. So there's key issues to take note. Okay, so they say PRU's property was purchased at a cost of 75 million on 1 January 2018. The cost is allocated between local and foreign in relation to the percentages given above. So out of the 75 million, 35 is local, foreign, and 65 is local. Each investment property has a minimum of 100 office spaces. Each office space can be leased out separately. That is, clients do not need to rent out the entire building or floor, but rather they can just rent an office space in the building. On 31 December 2018, the fair value of the investment property was 98 million. So remember, when it comes to investment property, there's two methods to measure investment property, either using the cost model or using the fair value model. Okay, so they're giving you this on the entire building is 98 million. Remember, only 95% is used for investment property. So you can only take 95% of this as your fair value. PRU had a six-month contract with a local company, CAA, in which PRU provides an office space for a period of 6 months for a legal team from Germany that CAA was working on a case with. Germany does not have a double tax agreement with Zimbabwe. Okay, so that means there will be some tax consequences. During July 2019, after staying for only 2 months, the German team vacated the office after being attacked one night when leaving the office. The attackers were thugs hired by a political figure being sued by CAA. The office was vandalized by the thugs during the attack. On 1 August 2019, Gibela sought legal advice on the matter, and based on that advice, sued CAA for a claim of 12,000. 30% of the claim was for unpaid rent for the remaining 4 months of the contract. 30% was for repairs to the office, and 40% was for loss of goodwill as Gibela's rating from clients in the property went down. Okay, so basically over here, that is a potential contingent asset. Okay, so IS 37, so we'll have to have a look how to deal with that. So they say CAA want to settle the matter out of court. So on 24 August, CAA paid 12,000 and Gibela undertook to abandon any rights it may have had for any damages and to also drop the lawsuit. Okay, the deferred tax movement for the 20-year. Okay, so it looks like there's going to be some deferred tax. So this thing over here, it has a PPE aspect. It has a investment property aspect. It has a I-37 contingent asset aspect, and it also have a deferred tax aspect. Okay. Okay, so they say Gibela often has, so note number 4, Gibela often has excess cash reserves as its software solution customers pay part of the contract amount upfront. In a bid to manage idle cash resources, Gibela purchased the following instruments on 30 September 2019. Okay, so this is probably going to be financial instruments. Okay, so here we have preference shares in a company listed on the Johannesburg Stock Exchange. So the cost was 12,000. Gibela would be paid a dividend of 10%. And then there we have a fair value. Okay, then we have zero coupon debentures. So zero coupon means there's no interest being paid. Okay, Gibela would receive a bullet payment at the end of 5 years, plus a premium on cost of 25%. No other cash flows would flow to Gibela. Okay, so there's the fair value, and there's 15,000. So it's just financial instruments. Okay, they say management identified that its policy for managing all its financial instruments was to collect contractual cash flows, and should Gibela face any cash constraints, they liquidate the investments. Management is confident that they have adequate cash resources to fund working capital, and it is therefore unlikely that they will ever liquidate the investment. Management did not make any classification designations. Okay, so basically, this is going to be, so remember, when you have a financial asset, you're either going to have amortized cost, fair value through OCI, or fair value through P&L. So this is most likely going to be amortized cost. Okay, but we will have a look. Okay, so general information. The finance director of Gibela provided the following figures for the 2019 financial year to the finance clerk so that they could come up with Gibela's income tax note. Okay, so profit before tax, investment property, see note number 3, property, plant and equipment, we must check that out, trade receivables, and then debentures, okay, and then trade payables. Okay, we'll have a look at that. So the profit before tax, all transactions have been correctly accounted for unless otherwise stated. Includes the following. Profit before tax includes the following items: legal costs incurred in relation to the issue, okay, compensation received from CAA, foreign rentals from properties in South Africa. Zimbabwe has a double tax agreement. Okay, Gibela has a staff canteen. Cost of running the canteen for the year. Staff is not charged for meals. They eat at the canteen. Okay, property, plant and equipment. Okay, so you can just read. We can read that just now. So here's some additional information. They say assume Gibela uses an annual post-tax discount rate. So here is important as a post-tax discount rate. Remember, in accounting, we're always looking for a pre-tax discount rate. So they're giving us 12%, so we have to work out what is the pre-tax discount rate. Accounting always want a pre-tax. Management accounting want a post-tax. Okay. All property, plant and equipment is subsequently measured at cost, less accumulated depreciation. Investment property is measured at fair value. Assume an income tax rate of 24%. Capital gains is levied accordance with the capital gains. Okay, what is that? 80%? I don't know. Assume that of 14.5. What is the capital gains tax rate for you guys?
It takes on immovable property and shares or marketable security.
What's the rate?
It's for immovable properties 20%. For shares, yes, depends. Some are 5%, some are 1%.
And what does it depend on?
Especially for marketable securities, it depends whether it's listed or unlisted thereabout.
Oh, okay, okay.
Yeah.
Okay, so let's just look at PPE. Where did I see PPE? Okay, PPE, property, plant and equipment, comprises of the following. A building used for manufacturing that the self-checkout machines was purchased on 10 January at a cost of 65. The building has a useful life of 25 years. At the beginning of April 2019, legislation was passed that all manufacturing buildings that produce smoke in the production process be fitted with a smoke filtration system. As Gibela's manufacturing system produces smoke, they fitted the building with a filtration which costs 1.5. The system has to be replaced every 6 years. The building is fitted with a plant that was purchased at a cost of 23 on 10 January. The plant has to be dismantled at the end of 10 years. Estimated dismantling cost at the end of its useful life is 15,000. Okay, so it's quite a nice question, lots of stuff happening. So let's go look at the required. We're going to go through some of the required, and then in the next lesson, we're going to focus on the revenue required. Let me just quickly check where is this required now. Okay, so here they say, discuss the accounting treatment of Gibela's contract with pick and drop in line with IFRS 15 from contracts with customers. Here they say ignore step 1 and 4. Okay, so you must ignore step 1 and 4. What is step 1? Step 1 is contract with customer. Step number 4 is allocate the transaction price. So what do they want? They want step 2, they want step 3, and they want step 5. So step 2 is to determine the performance obligation, identify performance obligations. Step 3, determine the transaction price. Step 5, it is to how do you recognize revenue at a point in time or over a point in time. 25% of the paper is revenue. Okay, quite a big percentage. Here's an issue of note number 2 where this Gibela ended with a supply to build a manufacturing plant. So as you can see, it's in the standard of IFRS 16. So we have to apply IFRS 16 leases to see how to deal with this particular question. So they say discuss, important, whether the journal entries raised by the accountant are correct, discuss in line with IFRS 16, ignore presentation and disclosure, show the correct journal entries, do not include 2018. Okay, you can ignore tax implications. Point C, discuss the accounting treatment of investments made by Gibela in note number 4. So note number 4, I think, was the financial instruments. Okay. And then over here, prepare income tax note for Gibela. To say, do not include the tax rate recon. Use all the information provided in the scenario in answering this question. So the income tax note. So we must prepare the income tax note, and we must ignore the tax rate reconciliation. Okay, so this is quite a big question. Okay, so in the next lesson, we will work through this answer. Now we need to spend time on on consolidations. So consolidations in paper 1. This is paper 2. Consolidations in paper 2 in paper 1. So what we need to do is you will have to select. You can decide. Okay. If you don't know which one, I'll tell you which one is a very good question. But if you don't, but if you want a particular one, then you can select one more of this scenario to that we can work through. Then the rest you will work through, but you can set up time with me. We can have a 15-minute one-to-one conversation if there's something specific that you want to ask me. Okay, so you can let me know after we're going to do the revenue one, and then you can choose one more, because then we need to go on to consolidations in paper 1. Okay, is there any questions from your side? Desiree, any question from your side? Jeffrey, Justin?
Not yet.
Not from me.
Okay. Jeffrey?
Nothing from me.
Okay. I don't know if Jeffrey's there.
I'm okay.
Okay. Leonard?
Yeah.
Lynn, Madeline? Any questions on your side?
I'm okay, thank you.
Okay.
No questions.
Shayla, Taure, Dinashi, Walter?
Not at the moment, Faiz.
Yeah.
Not at the moment as well.
Okay. So the next lesson, we need to just figure out a catch-up day. So it can't be, yeah, so I'll try to figure out a catch-up day, and then I'll let you know, then we can agree. And then, yeah, so the next lesson, so for now, the next lesson is going to be our normal time, which is Tuesday. Yeah, I think we have Tuesday and Thursday, right? Yeah, so the next lesson for now is Tuesday. We still have to make up a catch-up lesson still, but the next lesson will be Tuesday. We're going to do the revenue question. Because it is if there's still time, then we can do another, we'll see what other discussion question we can do. But in the meantime, we're going to do the revenue one. Then if you can, how can I say now? If you can let me know which other question of that scenario. So we're doing A, and there's B, C, and D. So which of B, C, and D do you want to cover? Because in the last lesson, we're going to do consolidations. Okay. Okay, so I'm going to stop here for tonight, and then on Tuesday we will do the revenue question. So please, I'm going to share this with you by tomorrow. If on Tuesday you can come with knowing the scenario. When I say knowing the scenario, just you have read it again. Okay, so you must have at least read it before we come to the class again, not based on now, but on your own, read it again. So when we come, I'm just going to go straight into the scenario and answer the question. Okay, so I'm going to assume you know the scenario. If you need to listen to the scenario again, you can rewatch this, but there's no requirement to rewatch this video. But it is a requirement for you to just read the scenario again and only the revenue section. So that means the background plus note number 1. Okay, and then the additional information. But the additional information is really quick, but note number 1 and the additional information. Okay, thank you guys. Bye-bye. If you have any questions, you can ask me. No questions, you can. It's good to go.
All right, thank you, Faiz. I think when everyone is gone, I just have one or two issues that I wanted to ask Faiz.
Okay, no problem.
Maybe Walter and Tau can remain behind.
We also want to hear the question if it's beneficial for everyone.
All right, it's still okay. It's still fine. I just thought, if you're in a hurry, it's still okay. It's not related to FAQ. It's actually Mark.
Okay. You can ask.
All right, that's okay. Just am I able to share the screen, Faiz?
Yeah. No, I'll give you a moment. Okay. You should be able to share. Let me know if you can share.
Okay, I'm sharing now, Faiz. Just a minute.
No problem.
All right. So, Faiz, we're working through a work question that I'm now sharing. There is one particular area on that question that we failed to figure out how they got to calculate the market value for the preferred shares. So I'm just trying to share now. How do I share? Oh, okay, share screen. Confirm you can see my screen, Faiz.
Okay.
All right. Is Walter still there?
Hi, Justin, I'm here.
Okay. I am in the right track, right?
Yes, you are. That's the
All right.
question 15.15.
Point 15, right?
Mhm.
Okay. I'm also trying to look for the solution here. So that I go right to where our concern is. All right. Oh, actually, it's okay. Yes, that's it. So fires on note 15 of this question, confirm that the screen that I'm sharing has got note 15.
No.
All right.
There
So
you are.
we managed to, yes, thank you. So we managed to calculate the market rate for the preference shares. I think we could follow that. We managed to do that one, but unfortunately we couldn't figure out exactly how we could calculate the market value for these preference shares. So I don't know how you can help us. Are you able to
Yes.
go through the notes now?
I don't know, read it quickly.
All right.
Oh, yeah, okay, I know what's happening here. So share the solution.
All right. So this is the solution. Okay. Yeah, here it is for the preference shares. So our main worry was this 5232,333 divided by the 10 multiplied by 7. We can't seem to find out where this 5232,333 is coming from. From a principal perspective, we tried to tackle it. It was quite difficult. Tried to go to the solution, and we're lost even more. But yeah, this is the solution. I think it goes down. Preference shares market value. Okay, it is. I think the market value 3662633 is actually coming from that 5232,333 that we said we couldn't figure out what is happening with that 52 to get to this market value.
Yeah.
Then I think there is another last table. I think there is this table. So okay. Definitely need to calculate the option, the future values. There's option 1 for to convert to cumulative preference shares, then redeeming at par.
Yeah, so I'll need to take you in detail, and I'll need to take you in detail to how to get this right. But the general principle over here, when we have a conversion option, okay, so it can be for debt, it can be for preference shares, so it can be for debentures, it can be for preference shares, where the arrangement is where you can convert it into you can convert these different options, right? So the first thing you're going to have to identify who has the choice to exercise the option. Is it you, the company, or is it the holder, the investor? Okay. So there's probably like 2 or 3 options available. So what's going to happen if the company has the choice to exercise the option, either of the options, then that means the company is going to choose the cheapest one. So what will have to happen is that you're going to have to work out the value of the preference shares for each conversion option. I think there was 2 or 3 conversion options. So we'll have to work out the value of the preference shares for each conversion option. Now, if the company have the right to exercise the option, the company will choose the cheapest option, because the company needs to pay, so they're going to choose the one that is more favorable to them. So the one that is more favorable to them is the cheaper one. They have to pay less. If the investor, the holder, have the option, they're also going to choose the favorable one to them. And to them, the favorable one is the one that costs the most, the one that has the highest value. So that is basically what you do. You first have to identify who has the option, and then you must work out the value of each of the preference share for each conversion option. And then you either choose the highest one or the lowest one, depending on who have the option to choose, who have the option to exercise. So that is basically how we'll do it. I can't explain in 5 minutes. This is like a 20 minute question, but the gist of what we try to achieve is what I just explained. I don't know if that
Okay,
explains.
great. Yes, I get that one. Thanks, Faiz. So now I think maybe so that we can have a traction, let me take you to this statement. Probably I just want to see how we can interpret this one. So the long-term liabilities consist of preference shares, right?
Yeah.
So the long-term liabilities, I think they're on the balance sheet. Yes, these long-term liabilities. Where is it? Long-term A 112, 900, 190, 303 for the different companies there, group etc. So there is some kind of you can't really have a breakthrough on this statement. Now it's saying long-term liabilities consist of preference shares and long-term loan, right? Which are split on a 50-50 basis in total. That's fine. Now, to get the number of preference shares which are split 50-50 with this long-term loan, we're kind of like failing to get the number of shares for these preference shares. I think that's where the biggest challenge was coming from. Trying to figure out the number of shares which actually on the solution. Just can't seem to interpret how they got this number of shares. Applying what you have mentioned will not be a problem after we got the number of shares for the preference shares. Walter, confirm that that's the position.
Yes, that's the position. And also I noticed something, Justin. Could you scroll to the answer just
Yes.
for 1 minute? It isn't. Do you see they chose the one with the, there was the second option, this part where they discounted it at 2019. Could you guide as far as, I thought maybe we could get 5232. Why did we discount it in 2019 using 1.18 to the power 3?
So 1.18 is the market. 1.18 is the 18% is discount rate. So in order to get it, well, that's going to give you the discount rate. That's going to give you, so the 5.2 over here is getting you the market value at year 3, but you want the market value at year 0. So then you must discount 3 years back. Send me this paper. When do you need to know those answers?
I think anytime tomorrow it's okay.
I don't have capacity tomorrow because I have presentations tomorrow, but I can do it on Saturday.
Okay.
Is that
Saturday,
okay?
that's okay.
Yeah, you know, can
Yes,
you send it to me? I need to just look at a little bit more detail into it. I need to, yeah, and then I'll try to explain it to you guys. Okay.
Okay, not a problem. Not a problem, Faiz.
Okay.
All right. Thank you.
Okay, pleasure.
All right.
Justin, just send me also like I'll chat to you to send me some more question papers. Okay.
Or
yeah,
no problem.
yeah, but send me this as well. Okay.
That's okay.
Okay. See you guys. Bye bye.
Okay, bye.